Welcome to Investor's Guide. It gives me great joy to welcome you to this very, very special show. In June this year, this show, along with the channel, turns 7 years old. That's over 350 episodes. I want to welcome Dhirendra Kumar. Dhirendra, thank you so much for joining us on the show. Today's episode is very special because over a two-part special, this week and next week, we're actually going to take a look at the returns our portfolios have given us. Now, I want to remind our viewers, 7 years ago, in June 2009, when we started this show, Dhirendra designed 5 portfolios for the show for various age groups. There was a portfolio called the Aggressive Portfolio for a 25-year-old, and there's one for a 35, 45, 55, 65-year-old. The idea is to design a portfolio based on the amount of time you have before retirement. But the fundamental principles of all of these portfolios remain the same, which is simply that you use an SIP when you invest in the market. That's first. All of these portfolios have used SIPs except for the last one, which is meant for a retired person. The second philosophy is that you invest in equity for the long term. So you look at it from a 10, 15-year horizon, which is what we've been doing. And finally, that you don't panic and you don't stop your investments irrespective of what is going on in the market. So the last 7 years might not have been the most friendly years for the stock market, but we've not stopped our SIPs into these portfolios. They've continued to run. They've invested for the long term, and we have not panicked. Today, we're going to show you the returns on these portfolios. I want to start off with the first one, which is our Aggressive Portfolio. This was designed for a 25-year-old. Take a look. All right, our Aggressive Portfolio, I'm going to give you a recap of the funds in that portfolio. There's the DSP Blackrock Short Term, Franklin India Smaller Companies, ICICI Prudential Value Discovery, IDFC Premier Equity, Quantum Long Term Equity. And this is the beauty of it. We've invested 8.4 lakh rupees. It's currently worth 16.45 lakh rupees with a total gain of over 18%, 18.78%. Dhirendra, the money has doubled in 7 years, which is fantastic. But I want to come back, of course, to the basic principles of this portfolio. The fact that we started off saying it has to be simple, it has to be easy to manage, and it has to be well diversified. Has it all worked out the way you planned and hoped that this portfolio would work out?
Yes, it has worked out very nicely, but I would just like to change the way you have just narrated the performance of this portfolio. It is not 8.4 lakh which has become 16 lakh and more. It is your 10,000 rupees monthly contribution. This portfolio is a demonstration of how a small saving with small saving you can accumulate a sizable amount. You never had 8.4 lakh. You invested, any investor would have invested 10,000 rupees a month, which is, and gradually built it to this point, your total contribution of 8.4 lakh, and that is worth 16.5 lakh rupees approximately today. So that is the keyword, small savings growing into something sizable and meaningful. That apart, all the principles that, and of course there are other riders to it, there are other highlights of the way these returns are derived. One that one would have made only 1 or 2 change in the whole course of these 7 years, which means that investors who believe that they have to really work hard on their investments, they don't have to. They have to get started, be disciplined, and it works out nicely. So that is another takeaway from this portfolio. And the third thing is that the other important thing which investors should take consolation or feel happy about is that all the returns that has been derived from most of the return derived from this portfolio is nearly tax free. Only your investments made in the last 1 year is subject to taxation, but as I would imagine that somebody is continuing this, and this is even 7 years. If you are far off from your goal, even that money will be free from the tax implication of short-term capital gains. Then it also validates some of the key principles that you diversify, you rebalance your portfolio periodically, and make minimal changes, and for a reason. In fact, I thought that we have made very few changes, but when I look at our aggressive portfolio, I realize that uh, of the 5 funds, only 2 remains, and the other 3 have been substituted in the course of these 7 years, and on 2 occasions these changes were made.
I want to ask you about the one fund that has stayed with this portfolio for the last 7 years, and just to illustrate to our viewers, when we started off, we had the Sundaram Smile, Reliance Regular Savings Equity, the DBS Chola Opportunities and the UTI Opportunities. None of these funds remain in the portfolio. What remains is the portfolio that you see on your screen right now. The fund that has, of course, stayed for the last 7 years is the IDFC Premier Equity Plan, Dhirendra. Tell us why this fund has worked out, and in the last 7 years, has it continued to behave in the manner that you expected it to? Do you expect to hold it for another 7 years?
I hope so. But yeah, IDFC did turn out to be a very promising fund then. And looking at the past performance, most of the time we are looking at the hindsight. But here we have a demonstration that we picked something, or we had something in our portfolio 7 years ago, and in the last 7 years it has done very well. And there has been a change. The fund manager changed, and we really took a stock of things in recent times. And we think that in a varied way, we will be looking at this fund very differently from here on. But at the same time, I hope that howsoever it may be derived, it continues to remain a promising fund with a different strategy.
So let's also talk about quantum long-term equity, Dhirendra. I remember when you added this fund to the portfolio, you were confident that the lower cost on this fund will actually lead to higher returns. And then over the last 1 year, you have yourself said that it hasn't really played out the way you expected it to. But you continue to hold it in the portfolio. Do you hope that over the long term, it will still result in higher returns?
Yes, I was actually disappointed, and particularly, I was questioning the very basic that this fund actually takes a cash call, which to my understanding was not fitting in with the reason why we have created this portfolio. We have created this portfolio with a 10% fixed income allocation. We want to remain invested, and that is the basic philosophy. We don't want to time the market with our cash positions, and this fund was precisely doing that. And but it looks like this fund was not very off the mark, and its portfolio focus to remain in relatively cheaper growth stock is playing out, and it is now beginning to show those results. So I would say that investors should also learn to have patience with some of these things, some of the basic tenets, or some of the basic variables which will drive the fund, and it will not work out favorably in the interim. And one should not be getting impatient based on 6 months, 1 year, or 1.5 year performance. And looks like we are not wrong.
And we are not wrong. Let's also talk about the DSP Blackrock short-term fund, Dhirendra. This is the debt component. Now, remember, for our viewers, the portfolio is meant to be 90% equity, 10% debt. This is the 10% debt. Now, to be fair, Dhirendra, this fund is still rated 3 stars on value research. There are some other debt funds that are rated closer to 5 stars. But are you happy with the kind of return? Or does this mean that if we have a debt component in our portfolios, there's no reason for it to be a 5-star fund because the difference is so meager between 5 and 3 stars in the debt portfolio?
No, I think in our overall scheme of things, having a 10% allocation to fixed income has 2 reasons. One is that just in case investors need the money, this is the first fund which one should redeem. Just in the interim, you need some money, though it is a long-term portfolio, but there could be situations where you need to draw on your money. So this should be one such allocation. The other is rebalancing. And your ability to rebalance, if you do not have a fixed income allocation, if you do not have an allocation to fixed income fund, and right now 10% of a sizable portfolio of 16 lakh rupees accumulated over the last 7 years is quite meaningful. So if your equity actually becomes 98%, 99%, just in case the market goes up by 10, 15%, 20% in a hurry, one should be able to realign. One should be able to realize some gains and move to fixed income. Unfortunately, in the last 7 years, we haven't got any such opportunities. The market never went crazy. I'm not very tempted to look at a 5-star. I was just looking at the basic hygiene in place of a should be in place for a fixed income fund. If I would have chosen the best performing fixed income fund, instead of 8.72% annualized return over the last 7 years, it would have been 8.9%, and I don't think it will be it will be meaningful. And it is important not to be very very active with your such allocation in a portfolio in a fixed income fund, because the tax implications are more intense. You have to hold it. If this fixed income fund investment is not tax-free as in equity, which you hold it for 1 year and it becomes completely tax-free. You have to hold it now. You have to hold it for 3 years, and it is subject to indexation. So it is better to, one has to look at it as a risk management component. A component in your portfolio which will reduce the risk of your overall portfolio rather than performance enhancing component.
Now, here are the principles on which this portfolio was put together, that we'll only have we started off with 6 funds, we now have 5 funds in this portfolio. So it's easy to maintain, it's low maintenance, it's diversified across the market. We will use only SIPs. There are no lump sum investments made in this portfolio at all. And of course, there will be rebalanced on a periodic basis. Like Dhirendra said, the stock market over the last 7 years has not given us any fantastic, out of the park windfall returns. There hasn't been a need to rebalance. But in spite of that, look at the returns we're talking about. Only 10,000 rupees invested every month. That 10,000 has not even increased. It has stayed at 10,000 rupees for the last 7 years. And the money has doubled. It's currently worth 16 lakh rupees. I'm going to give you a recap of the funds in this portfolio so you can write them down and use them for your own investments. There's the DSP Blackrock Short-Term Fund, the Franklin India Smaller Companies, ICICI Prudential Value Discovery, and of course the IDFC Premier Equity Plan and the Quantum Long-Term Equity Plan. We continue to invest 10,000 rupees a month in this portfolio. The returns are plain and visible for all to see. We're going to take a quick break. We'll come back and talk about our growth portfolio. We'll look at the returns there and find out what principles have actually worked for this portfolio in the last 7 years. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. Thank you for staying with us for the last 7 years. This is our 7th year anniversary episode. And remember, we are, of course, India's longest running personal finance show. We have results to show it. Like Dhirendra was just illustrating, in our aggressive portfolio, we've gotten a return of over 18%. 10,000 rupees invested every month in this portfolio has accumulated to over 16.5 lakh rupees. And Dhirendra, there's something very beautiful about this portfolio. The fact that it is aggressive. I mean, 18.5% return is extremely aggressive given the market that we've seen. And the thing about this market in the last 7 years is that we've had some really bad patches. We've had some periods where people investing in equity have been very, very worried. But this portfolio has technically never been in negative returns, has it?
No, it has not been, and I think that is the most comforting part of it. If somebody would have initiated and the comfort that he will derive, that at any point he would have looked at the performance of his overall portfolio, he'll find that he's not in losses. That is very comforting for a aggressive growth portfolio. The other thing which people highlight, which people complain sometimes, that it's not aggressive enough, because they don't see a fund which looks aggressive or looks like the racy fund which has done exceedingly well in the recent past. The way we have devised it, that we have taken credible funds with long track record, with an eye on our overall allocation to mid and small cap funds managed by credible managers, with credentials there, and that has worked out nicely. Our fund, our aggressive portfolio looks like same mundane, boring funds. But the overall allocation, because of the portfolio mix, turns out to be nearly 50% into small and mid cap, and the 10% allocation to fixed income. I think that one works wonder. Many a times people say that why this fixed income, and that I think has contributed heavily to comforting the investor in the worst of times, that it has not been in red.
All right, so our aggressive portfolio is on your screen right now. We also want to talk about our growth portfolio. Now, this portfolio was designed for someone who's 35 years old. It was meant to give you a slightly more stable approach to the market than the aggressive portfolio. And we'll talk about the difference between the two, but I want you to first take a look at the returns. All right, so that's our growth portfolio. A quick recap of the funds in this portfolio. The FT India Dynamic P Ratio Fund of Funds, ICICI Prudential Dynamic, Quantum Long-Term Equity, the Templeton India Equity Income, UTI Equity. Again, 10,000 rupees invested in this portfolio every month. That has accumulated, of course, if you add up 10,000 rupees over 7 years every month, that's 8.4 lakh rupees. The total value of that money is now over 13 lakh rupees with a total gain of close to 13%. Devendra, I just want to focus on the difference between the aggressive and the growth portfolio. You yourself has received a lot of criticism from viewers and readers who've said you're not aggressive enough. You're not taking, stances on, say, infrastructure or pharma when it was doing well, or banking at the time that it was doing well. You remained diversified. You've not picked any of those seemingly aggressive funds. Tell us the difference between this kind of aggression and that kind of aggression, where you pick specific sector, theme-specific funds.
No, I think that investors should value different people's expertise. It all looks very impressive with the hindsight. Everybody will be impressed with pharma after it has done well, but it's very hard to guess when something will do well after you have invested. I haven't come across too many investors who have benefited from this pharma boom of the last 7-8 years. In that meaningful way. There will be private investors who will be investing in such stocks directly, but I haven't come across somebody picking sizable amount of pharma funds 5 years back and riding the full cycle. So if you look at our portfolio performance can be attributed to a lot of things that we haven't done. We haven't changed often. We haven't been carried by a lot of things that happens, which prompts you to do things. We haven't invested in any of the NFOs. We haven't really gone haywire with our allocation. Our growth portfolio, which has 80% into equity, 20% into fixed income, we do take a look at it every 3 months and find that if it is in a band of 3% plus minus, we tend not to fiddle with it.
Devendra, in fact, this portfolio also has seen a lot of changes. Just to remind our viewers, when we started off, we had funds like HDFC Top 200, UTI Dividend Yield in this portfolio. We also had the Birla Sun Life Frontline Equity. We have a completely different portfolio today because it received one overhaul at one point of time. You switched to the FT India Dynamic P Ratio Fund. Again, this was a new fund. We hadn't talked about it up till then on the portfolio. Tell us why you picked this fund, and tell us if it's in several of the other portfolios as well, which is why it's an interesting concept. Tell us if it's worked out the way you expected it to work out.
We worked on an allocation of 80% to equity and 20% to fixed income. We filled that 20% to fixed income with 2 fixed income funds, and then we picked 6 equity funds, and 6 equity fund largely, and a good part of the portfolio, nearly 50%, was anchored to a multi-cap fund, and they continue even now in the portfolio in a very meaningful form. But after 6 months, after 1 year, 2 years, we realized that it was turning out to be very messy. The fixed income allocation in 2 funds, we were not going to actively manage it. We were not trying to maximize return. It was more of a risk allocation. So we needed a reasonable fund. We needed a good fund, but not an extraordinary fixed income fund. And it is very difficult. The payoff of picking an extraordinary fixed income fund compared to a reasonable equity fund is hardly meaningful. So we thought of simplifying that. Then we wanted a dynamic allocation to fixed income, which we were able to derive from the Franklin India Dynamic P Ratio Fund. So we just had that fund with an allocation on the assumption that the overall allocation of our portfolio will just remain 20%. And things will change depending on the level of the market, because Franklin India Dynamic P Ratio Fund was the only fund where the allocation to equity and fixed income changes depending on the valuation of the market, and that has worked out very nicely. The biggest payoff of that particular decision is that we did not have to make any change, because every time there was a need to rebalance, the portfolio would have automatically rebalanced at the fund manager level. So that has really contributed to the simplicity of the portfolio. Now we just have 5 funds in our portfolio, and without the need to rebalance.
Devendra, I want to ask you about the Templeton India Equity Income Fund. It's rated 2 stars on Value Research. Do you want to hold on to this fund and continue to display faith in it?
No, this fund is due for a substitution, and in the coming weeks we'll be making a change. The reason why this fund was was there, and it has done well in this portfolio overall, but the basic principle, the basic rationale of having this fund was to get the fixed, have the international exposure in some form, and that this fund was the only meaningful vehicle at that point, which was making me available that exposure with the treatment of Indian equity in a very tax efficient manner. But today we have far more impressive, and I was waiting for an occasion when some of the options which we were looking at, which were relatively new, they start attaining a basic life where they are rated, and they have come into being. So this fund is due for substitution. This fund remains a reasonable fund from that point of view, but they're far more superior alternatives and due for substitution now.
But just to give you a recap of our growth portfolio, remember, designed for a 35-year-old. This is a recap of the funds in this portfolio, the FT India Dynamic PE Ratio Fund of Funds. Remember, Virendra told us that he's picked this fund because it automatically rebalances the portfolio. That's one less thing for you to worry about as an investor. The other thing the other funds in this portfolio are the ICICI Prudential Dynamic, Quantum Long-Term Equity, the Templeton India Equity Income, which is due for a change, which will happen over the next couple of weeks. The UTI Equity Fund. We've been investing 10,000 rupees in this portfolio every month for the last 7 years, and it's currently valued at 13,33,414 rupees, with a total gain of nearly 13%. If you have any questions about this portfolio, feel free to get in touch with us. Our email ID is at the bottom of your screen. We're going to wrap up this episode right here, but remember, it's part of a 2-part series. So next week at the same time, we'll come back with the 3 other portfolios. This designed for a 45, 55 and a 65-year-old. Will tell you how these portfolios have been doing over the last 7 years and whether or not you should be adopting these portfolios now. We have proof and evidence of what happens when you invest through SIPs for 7 years. Thanks for watching.